All right, in today's Money Watch, we're told we got to move along. We're answering your money questions. Well, not me, not we, more like CBS News business analyst Jill Schlesinger, who is a certified financial planner and regularly gives advice on her Jill on Money radio show and podcast. She is here now to receive and to tackle your questions. Jill, good morning to you.
Rapid fire, baby.
All right.
I'm excited.
What's first?
I don't know.
I got
running
snack
All right, here we go.
papers here.
Carrie from Santa Fe writes, my wife and I are 33 years old and recently found out that she is pregnant. Is it okay to buy life insurance through my work?
Absolutely okay. The thing you want to make sure about is that you can take that insurance with you if you leave that place of work. So that's called portability. You can take it from your employer and grab it with you. You keep paying for it. Now, if you're young and you're healthy, you may want to get your own term life insurance somewhere online. It's very cheap. Again, if you're in your 30s and you want to get coverage, it's very easy to do. And that might be another solution, just so you don't have to worry about, oh, if I leave my job and how much it's going to cost.
And it's called term because it's good for a certain term of time.
That's exactly right. I would say 95% of the time, term coverage is absolutely adequate. You need it for a period of time until your kids get older, until you've accumulated enough wealth and paid down your debt. That's why term life insurance is really considered the most affordable.
All right, we got a next question from Mandy here from Connecticut. She just bought her first home and says she's spending a lot of money doing cosmetic things, like landscaping and painting. And so she asks, how much do I need to set aside for ongoing maintenance?
Okay, anyone who knows that, like, when you own a home, there's these unexpected things that come up. And so the rule of thumb has always been keep 1 to 3% of the purchase price set aside just because you don't know. Now, if you've got a brand new house, maybe it's 1%. But if you bought one of these old historic houses, you're going to find things need fixing. It could be a boiler, it could be a roof. And so we want people to be in the habit, if they are homeowners, to keep a little bit of extra money in that emergency reserve fund, just in case something bad happens. And again, it may not be every year. You will be happy you didn't have to throw out that credit card if something bad were to happen in the home.
This is a great question from Morgan from Seattle, who has a mortgage at 6% and wants to know whether they should invest extra money or use it to pay down that mortgage at 6%.
You know, anyone who has gotten a mortgage in the last, say, 2 years has not really been able to have that normal thing like, don't pay the mortgage down, invest it, it'll be better for you. But when we're talking about 6-7% mortgages, it's a little bit scary to think about having that for a long period of time. Now, normally, the reason why I don't love paying down a mortgage is you lose access to that money. So that if you had that boiler explode or something happen, but I can get on
because
board.
you're spending extra money you may have saved for the boiler
Yeah,
fix?
and so one of the things, we call that liquidity, access to having your money. So it's a great idea to pay down a mortgage that's at 6 or 7, even 8%, but don't forget, you actually need to make sure you've got that emergency reserve fund. So don't dip into your safety net to pay down the mortgage. You want to throw a little bit of money down? I can get behind it. I want people to be clear that they still have to do the most important money moves, which is, number one, that emergency reserve fund, 6 to 12 months of your living expenses. Pay down that high interest debt like credit card debt or even an auto loan that's expensive. And of course, maximizing your retirement account. If you got that covered, then I'm okay. Pay a little extra towards the mortgage.
I love that. Okay, Delilah from Florida writes, when the time comes and my daughter inherits my assets, like my house, how does she avoid probate? She is my only child. Does she need a trust?
Okay, so probate is a legal process that basically says to the state of where you live, hey, here is my will, here's my stuff, here's the person who's going to manage it. In this case, Delilah's daughter. Now, why would you need a trust? Well, a lot of people like a trust because then assets that are in a trust don't go through the probate process. And you know what else doesn't go through a probate process? Life insurance or a retirement plan, anything that names a beneficiary. But of course, creating a trust costs money. So in many cases, I will just say, look, don't worry about the probate process. Make sure you've got your will. Make sure you've got your power of attorney. Make sure you've got your healthcare proxy. Make sure that any account that you can assign a beneficiary, you do that. But if it's just a house and your physical stuff and that's the only thing that goes through probate, it's okay. It should not be too onerous.
All right, Jill Schlesinger, thank you very much.
I learned a lot.
Appreciate it. If you've got a money-related question for Jill, send an email to askjill@cbs.com, and she might answer it in an upcoming segment like the one you just heard.
Love that segment.